اما یه سری استراتژی پیشرفتم هست که واقعا من تو این مدت ندیدم بچه‌ها استفاده کنن. در حد یه مرور 5 دقیقه اونا رو میگم، بعد براتون یه سری کلیپ انگلیسی هم میذارم که تک تک اینا رو توضیح میده. ولی واقعیتش اینه که تا زمانی که بازار ما عمق نگیره اینا کاربردی نیست. یک، استراتژی خرید سهم یا سکه و خرید اختیار فروش، بهش میگن مرید پوت. سهمو بخر، همزمان اختیار فروشش هم بخر. این اصطلاحا چی میشه بچه‌ها؟ چه کمکی میکنه؟ بهش میگن بیمه. مثلا شما 1 میلیارد فولاد داری، کنارش میری 100 میلیون اختیار فروش میخری. چجوری پوشش ریسک میده؟ این الان اینایی که امروز رفتن خودرو پوت آپشن خریدن احتمالاً شاید به خاطر این بوده. به خاطر اینکه اگر قیمت ریخت، پوت آپشن سود میده، ضرر سهمو جبران میکنه. و این پوت آپشن رو باید بر اساس چی بخریم؟ پوت آپشن رو باید بر اساس اون دلتاش بخریم. حواستون باشه. خب ما چون پوت تو ایران نداریم خیلی کاربردی نیست. دومی، یه اختیار خرید با اعمال پایین میخری، یه اختیار خرید با اعمال بالا میفروشی. به این میگن کال اسپرد. با اعمال پایین میخری، با اعمال بالا میفروشی. به این میگن کال اسپرد. کاربردش چیه؟ کاربردش اینه که سود شما در صورتی که قیمت ها بریزه، شما فقط مابعد تفاوت این دوتا زیاد میکنی. در صورتی که قیمت ها بره بالا، مابعد تفاوت اعمال سود میکنی. بازم میگم تو ایران خیلی کم از این استفاده میشه فعلا، ولی اشکالی نداره. مثال براتون چند تا پی دی اف میفرستم. رو بورس ایران ما تحقیق کردیم. مثلا شما خودروی اعمال 250 رو میفروشی، خودروی اعمال 200 رو میخری. پرمیوم 200 مثلا 20 تومنه، پرمیوم 250 10 تومنه. کل زیانت میشه چند تومن؟ گفتم کل زیانت میشه تفاوت پرمیوم. پرمیوم. کل زیانت میشه 10 تومن. کل سودت میشه چند تومن؟ میشه 50 تومن. اینجوری کنترل ریسک میکنی. ولی کاربردی نیست و الان هم هر چی توضیح بدم فایده نداره. مثال پی دی اف براتون میفرستم رو بورس ایران که ببینید. ولی من ندیدم تو این مدت، واقعا خیلی باید حرفه‌ای باشی که بتونی پیاده کنی. برای اینم براتون ویدیو میفرستم. خب استراتژی فروش اختیار خرید، فروش اختیار فروش که اصلا چرت مطلقه، هیچ سراغش نرین، چون دو تا فروش، دو تا وجه تعظیم باید تو ایران بذاری. استراتژی خرید اختیار خرید، خرید اختیار فروش. حالا این بد نیست. این چه کاربردی داره؟ یه اختیار خرید میخری، یه اختیار فروش هم میخری. این چه کاربردی داره؟ اگر قیمت رشد کرد این سود میده، اگه قیمت افت کرد این دقیقاً هج دیگه. اگر قیمت رشد کرد این سود میده، اگه قیمت افت کرد این سود میده. فقط در ازا شما دو تا چی دادی اول؟ زیانت چیه؟ دو تا پرمیوم دادی. دقیقاً. نه میگم دیگه، چون نداریم، کم داریم، تو ایران کاربردی نیست. برای همینم از اینا رد میشم. مثلا ما تو دوره‌های قبلی یه جلسه راجع به اینا حرف میزدیم، ولی واقعا من هنوز دانشجویی رو ندیدم که اینا رو گرفته باشه. فقط مرور میکنی. به موقعش اگر واقعا بازار ایران عمق داشت مثال میذاریم. خیلی خوب. جمع‌بندی. اینو یه جای گوشه یادداشت کنی. تمام حرفایی که من زدم اینجا خلاصه میشه. ما هر آپشنی رو کجا بخریم؟ شما اول برو ببین بازارت کدوم یک از این 9 تا حالت. بازارتو که انتخاب کردی، بعد برو سراغ یکی از اینا. بازار اگر سعودی پرهیجان بود چیکار کنی؟ تو عکس معلومه. اگر بازار سعودی پرهیجان بود کال بخر. میبینین دیگه جدول که بلدین چجوری کار میکنه دیگه. تقاطع. چون گاهی وقت سکوت میکنیم من میترسم صدا قطع شده باشه. الان میفهمین کجاست دیگه. بازار سعودی است پرهیجان، کال بخر. خب حالا خودتون بگین شد نزولی پرهیجان از این جدول کجاست؟ نزولی پرهیجان شد پوت بخر. نه بخر دیگه. نزولی پرهیجان، پوت بخر. خب بازار شد سعودی کم هیجان. سعودی کم هیجان، پوت بفروش. بازار شد نزولی کم هیجان، نزولی کم هیجان، کال بفروش. وسطش متوسط شد، هم خرید پوت هم فروش کال. مثلا الان بازار ما متوسطه، هر دو منطقی است. خب حالا اگر بازار خنثی و رنج شد، که من فکر می‌کنم ما امسال احتمالاً یه بازار رنج داشته باشیم، سه تا استراتژی میتونی داشته باشی. اسپرد کدوم بود؟ این که گفتم یک کال بخر، یک کال بفروش، بهم میگن اسپرد. یک کال بخر، یک کال بفروش، که چی میشد؟ هم زیان تو محدود میکرد هم سود تو. اگر پس خنثی متوسط بود این کارو بکن، مثل الان. اگر خنثی بود ولی پرهیجان، خنثی پرهیجان یعنی چی؟ یعنی مثل بیت کوین، میره بالا میاد پایین، میره بالا میاد پایین، میره بالا میاد پایین، میره بالا میاد پایین، ولی خنثی. استرادل بخر. استرادل کدوم بود؟ دو پایه‌ه. یک کال بخر، یه پوت هم بخر، که ما تو ایران الان نداریم ولی میشه تستش کرد. و اگر بازار خنثی کم هیجان بود، استرادل بفروش، که در ایران به خاطر اینکه دو تا وجه تضمین داریم ما اینو نمی‌کنیم. تو اون ور چون وجه تضمین رو میشه بلوکه کرد، نه. پس ما الان استراتژیمون معلومه. چون تو بازار ایران ابزار رو نداریم، فعلا اینا رو میذاریم کنار، میریم سراغ اینها و اون استراتژی تجربی‌ها. ولی من پلنم اینه که حالا چون این دیگه آخرین کلاس آنلاینمه، به مرور زمان حالا یا گروه کارآموزی داشته باشیم یا اینکه اصلا همینجوری خودم به صورت رایگان روی کانال‌های مختلف این استراتژی‌ها رو بذارم. بحث ما الان تمومه. من فقط براتون یه 10 دقیقه روبی از روی سایت ضبط کنم. خب همون سهم منظورشه دیگه، بازار سهم شما، نه که بازار کل. مثلا شما خودروبازی، خودرو منظورشه. مثلا خودرو الان بنده خدا مدت هاست نزولیه دیگه. خودرو نزولیه، ممکنه برای دارنده زاگرس بازار سودی باشه، ولی برای دارنده خودرو بازار کلا نزولی کشنده است.
So let's talk about bull spread here. So we have invited Mike here, and Mike is a very good investor. He is looking at Google, and he thinks that Google is going to go up, and the price for Google is right now $700. But the thing is that he do not want to spend $700, and he wants a protection. So how can he do that? The one way is that he can buy a call option, right? So call option. So let me start first with the chart of a stock itself. So if I'm looking at the profit, the call option, the stock, and this is the stock price. So this is a profit. So if Mike enters in the stock at this point, or $700, he will make money if the stock price goes up, and he will lose money if the stock price goes down. So it's a linear relationship. So that's pretty obvious, right? However, instead of the buying the stock itself, he can also buy just the call. So if he buys a call at 700, he might have to pay a premium, and a premium for the call could be around say $10. So he would have to pay $10. Because he paying $10, he is already starting with a loss. So that will be equal to $10. So he has to pay this $10 to start, right? And then once the stock will go up, he'll make money. And if stock will not go up, he'll not lose a lot of money, but he'll just lose the premium which he paid, and that will be $10. However, if you look at this, he would have to wait at least stock to go $10 up for even to start make any money. So that is the case with the call option. So now what he can do is, because he's looking for upside, but he's thinking that okay, it's going to go up, but I don't think that it's going to go more than 720. So he thinks that 720 is the maximum I will look forward to, and if it goes to 720, then I don't have to worry about, I will sell it. So what he can do is, he can look at the call option at 720. So call option at 720 could be $5. So because he is not interested in the upside, or like he is not thinking that the Google is going to go more than 720, he can sell the call at $5. So if he sells the call, he'll get this as a credit. So in that case, he is putting a cap on the upside. So if you look at here, so now let me do the bull option. So he is putting a cap here. So he's saying that, okay, I don't want any profit which will be above 720. I'm willing to do that. In return, give me $5. So when you give him $5, he's going to save that on the premium. So he's now his investment is less because he just need to pay $5. And because he's paying $5, he can make profit just by stock going to $5 more, and then he'll start making the profit. So down his profit chart will look more like this. So he put a cap there, and by putting a cap, he lowered his investment, or the amount he's risking in this investment, and therefore he is also limiting his profits. So that is what is called a bull spread. So I hope this video helps, and in the next video we'll go to the Google chart and look at the call premiums and say how much money you can really make by investing into the bull spreads. I'll see you again.
A married put strategy consists of buying a put option and the underlying stock at the same time. The strike of the put option is the price at which the downside protection kicks in. The strategy resembles buying insurance against the stock, and the insurance ends when the put option expires. To build a married put, you need to buy 100 underlying shares as well as a put option. A trader using a married put expects the share price to rise, but fears a sharp drop in price in the short term. The ratio of this strategy is 100 to 1. If you buy 100 shares of the underlying stock, you need to buy one put option. The maximum gain is unlimited. The maximum loss is limited to the difference between the purchase price of the stock and the strike price of the put option, plus the net premium paid. The break-even is the purchase price of the stock plus the net premium paid. Let's take a look at the payoff diagram. A represents the strike price of the put option purchased. The point indicates the break-even. If the stock closes on the expiration date at a price that is higher than the break-even, a profit will be realized. On the other hand, if the price at expiration is lower than the break-even, a limited loss will be incurred. In a married put strategy, the maximum loss will be incurred when the price of the stock is less than A. Ideally, the price of the stock would be higher than the break-even. The potential profit under this strategy is therefore unlimited. Consider the example on Husky Energy, ticker symbol HSE. First, you buy 100 shares of HSE at $16.66 each. Then you buy the put option with a strike price of $16, paying a premium of 23 cents, for a total cost of $16.89 including the shares. Now let us analyze what is at risk. The total cost is $1,689. The maximum gain is unlimited. The maximum loss is $89, which is the difference between the $16.66 purchase price of the shares and the $16 strike price of the put option, plus the 23 cents premium paid on the option. The break-even is $16.89, and the option has a term of 14 days. Calculating profits and losses on this strategy is quite straightforward. Calculate each leg separately and determine the net result. The first column shows a simulation of share prices on expiration date. If the share price is below $16, the put option is in the money. The limited net loss is then the difference between the share price at expiration and the price of buying the stock plus the value of the put option less the 23-cent cost of the hedge, for a net loss of 89 cents. The break-even, or the price at which the strategy becomes profitable, is $16.89. If the share price rises above $16, the put option is out of the money. The profit and loss is therefore the difference between the cost of the share on expiration of the options and the purchase price of the stock, less the cost of the hedge. The potential profit is therefore unlimited.
Now that you understand why options exist, I'm going to show you ways you can trade options to make a profit. So, most of your favorite companies that you use every day have stock options, and you can trade them right from your computer, cell phone, or tablet. There are two types of options. There are calls and puts. If you buy a call, you want the stock to go up. If you buy a put, you want the stock to go down. Now, since there are two sides to every market, you can also do the opposite, where you would sell the option as an opening trade and hopefully buy it back at a lower price as a closing trade. This will make more sense in a second. Option prices are based on three elements of its underlying stock. The first one is time to expiration. In the last video, we talked about how options are basically insurance, and of course you pay money for this insurance. Now, the thing about insurance is you don't just get to pay a one-time payment and have insurance forever. You have to pay month after month to keep your insurance. So the longer you have it, the more money you will have to pay. Options are the same way. They have expiration dates for the exact same reason you have to pay monthly for car insurance. An option with 60 days until expiration might cost $500 when the option with only 30 days to expiration only costs $250. So more time equals more money. So naturally, as time passes, an option's time value will decay. This is known as time decay. Now, let's take a look at how an option's time value will decay over time. The curve will look something like this. As you can see, time decay isn't linear, it's exponential, meaning that as you get closer to expiration, time decay will rapidly speed up. The important thing for you to understand right now is that an option's time value is always decaying, 100% of the time, every day, every hour. This can be your worst enemy if you trade options the wrong way, or it can be a huge advantage if you trade them correctly, which I'll show you in the next few videos. Most stocks have options with weekly, monthly, and quarterly expirations, and you can choose whatever expiration you want to trade in. And in some of my other videos, I talk about the best expiration that provides the lowest risk and the highest returns, so be sure to check those out. So the second factor that goes into option pricing is the price of the underlying stock itself. For each stock, there are multiple options at different price increments. These are called the option's strike price. The strike price is the predetermined price at which the shares of stock will be exchanged if the option is exercised. For example, if you own the stock at $125 per share, you could buy the 125 put because that's where you could sell your shares in case the stock goes lower and you need to exercise your option. So again, the strike price is simply the price that the shares of stock will be exchanged if the option is exercised. Of course, you don't have to own shares of stock to trade options, but the strike price of the option you're trading has a huge effect on what the option's price will be. Let me explain. Let's say the current stock price is $125 per share. For call options, any option that has a strike price above the current stock price is referred to as out of the money. If the strike price is below the stock's price, it is referred to as in the money. And for put options, it's the exact opposite. I know this is a lot to digest right now, but soon it will become second nature. So here's an idea of what each option's price will look like with, let's say, 30 days to expiration. And just a quick note, each option contract represents 100 shares of stock. So these prices have a multiplier of 100. So, for example, if you buy one contract of the 125 call, this will actually cost you $500, not $5. So here's the thing. All out-of-the-money options have no value at expiration. Let me repeat. If an option is out of the money at the expiration date, it will be worthless. So if they won't have any value at the expiration, then why do they have value now? Because stock prices move, and there is a chance that the out-of-the-money options could become in the money if there is still time left to expiration. Now you can see that the further out of the money an option is, the cheaper it is. That's because the likelihood of it being of any value is less than an option that is closer to the stock price, right? Because, for example, this stock is more likely to get to 130 than it is to 135. And as stock prices move on a day-to-day basis, the option prices will also move. If the stock goes up, the calls will become more expensive and the puts will become cheaper, and vice versa. Now, a common misconception is that you have to hold your position until the expiration. This isn't true. If you buy a call option today that expires in 30 days and the stock goes up overnight and your call option is now worth $100 more than it was when you bought it, you can sell it for a profit. The expiration date of 30 days does not mean that you have to hold the position that long. Now, you see the prices of these options with 30 days left until expiration. Let's take a look at what these option prices will look like with 0 days left. You can see all out-of-the-money options are worthless, and the in-the-money options are worth the difference between the stock and the strike price. This is because since there is no time left, there is no time value left on these options. This is also referred to as extrinsic value. The third and final factor that goes into option pricing is volatility. Volatility is referred to as the magnitude of a stock's price swings. Higher volatility means bigger price swings and ultimately more risk for the investor who owns stock. Since there is more risk involved, options will be more expensive. Why would the option seller not demand more money if they're taking more risk? Let me explain. I know you're probably sick of the insurance analogy by now, but let's say you are providing life insurance for two different people. The first person is overweight, smokes a pack a day, and has a medical condition. And the second person is healthy, exercises regularly, and has no signs of any life-threatening medical conditions. Now, who do you think will have to pay more for life insurance? Exactly, the person who is at more risk of dying. Now think of this person as a stock with high volatility and this one as a stock with low volatility. Now, different stocks have different volatilities, but volatility is something that moves around. A stock with low volatility now might have high volatility in the future. Volatility is much more predictable than stock prices, so if you're trading options, it's important to position yourself on the right side of volatility. This is the backbone of my trading strategy, which you'll learn about in the next few videos. And the combination of these three elements is what determines option prices.
Let's say that company ABCD is some type of a pharmaceutical company that has a drug trial coming out, and you're convinced, it's right now trading at $50 a share, but you're convinced that if the drug gets approved, that the company's stock is going to skyrocket. And you're also convinced that if the drug gets rejected, that the stock price is going to tank to maybe $5 or $10. So if you wanted to make money off of that belief, and I'm not necessarily recommending that you do, it's always trickier in reality than it sounds on paper. But one way that you could is you could actually buy both the call option and the put option on that stock. The put option is going to make you money if the stock tanks, and then the call option is going to make money if the stock becomes, if the drug gets approved and the stock skyrockets. So let's actually draw the payoff diagram here. So if the stock goes down, just let's say it goes down to 0, you would exercise the put option because you could buy the stock for 0 exercise your put option and sell it for $50. This is the right to sell the stock for $50. And of course, we're talking about the value of the combination now at expiration. So if the stock is worth 0 at expiration, the value of the put option is worth 50. The call option is clearly worthless. You wouldn't exercise the call option if the stock is worth 0. You wouldn't want to buy something for $50 that's worth 0. So from the stock being worth 0 all the way up to the stock being worth 50, you would want to exercise the put option, but the value of the put option is going to become lower and lower and lower. And anything above 50, you wouldn't exercise the put option at all. But if you get above 50, you would want to exercise your call option. If the stock is worth $60 at expiration, then your call option is worth 10 because you have the right to buy something for 50 which you can sell for 60. So then you have the value of your call option going up. So you can see a situation here when you just think about the value of this bundle of the call plus the put option, that it's not much value if the stock doesn't if the value of the stock doesn't change from 50, your options are worthless. But if you have a major movement either to the upside or the downside, then this straddle, it's called. Let me write that down. When you go long a call and you go long a put, this is called a long straddle. In a long straddle, you benefit from a major price movement. And when you think about it from the profit and loss point of view, you just shift it down based on the amount that you paid for the two options. So in this case, we paid $20 for both options. So in this situation where we would exercise the put, instead of making $50, we have to net it for the $20 we paid for the options. So we would only make $30. And at the point where we're not exercising either option, because they're both essentially worthless, no reason to exercise them, then we essentially have just lost $20 for both options. So we will be down over here. And then anything above $50 will start to make money. So let me draw the option diagram over here. It will look like this. It will look like this, the payoff diagram. It will look just like that. So when you actually factor in how much you paid for the options, you now see that you only would make money with this straddle if the underlying stock price, maybe after the results of the trial are released, and hopefully they get released before the maturity of the actual options, if the stock goes below, if the stock goes in this area, if the stock goes below $30, or if the stock goes above $70. But if it has one of those major movements, then this position, this straddle, this long straddle, will make you money.
I've had financial crashes. I've had people stab me in the back. But they're all good because I grow from it. That's spirituality. Right. You know, people who are afraid of making mistakes, like they teach in school, they don't ever grow. Because spirituality is there's good and there's bad. There's right and there's wrong. There's up and there's down. Most people only want to be right. They only want to be positive. Well, you can't have that. That's not reality. Well, I wasn't poor by most people's standards, but I came from a family with a poor attitude, if you know what I mean. Because rich, poor, middle class, poverty starts with a fundamental attitude. Poverty is passed on. It's taught in your families. And middle class is taught in families. And so the people right now who are sitting at home, who are struggling financially or worried about money or unhappy, they may be making a lot of money, but unhappy with what they're doing, it was probably taught to you. You know, your super ego was taught, get a job, work hard, or you'll never be rich, or the rich are evil, or whatever. The school system will never teach you about money. The school system was designed to teach you to be an employee, which is important, or a doctor or a lawyer, a specialist, but never about money. And what most people lack is real business knowledge, like accounting, you know, like debt, like taxes. You got to know that stuff, but they don't teach it in school to anybody.